Hi, everyone. Today we're speaking with Victor Haghani. This is a real treat because Victor is one of the founding partners of Long-Term Capital Management. And you might know this, you may not. It's back from the 90s. It was one of the biggest hedge funds, if not the biggest, and incredible rates of return all throughout the 90s, but did eventually collapse in 1998. But what made this so impressive was the list of founders. I mean, this was the who's who in finance. A couple of Nobel laureates, equations written after them. This was, even the Bonfire of the Vanities, Tom Wolfe novel mentioned bond traders as the masters of the universe. And this is this group. And what I want to do is I want to read a little take from a book called Liar's Poker. And it's one of my favorite books. It's written by Michael Lewis, who wrote The Big Short. So many of you have seen that movie, The Big Short, an excellent look into the 2008 financial crisis. Of course, Michael has a gift for being able to explain finance and very difficult derivatives and loaning structures in a very easy way, because he worked as a bond trader and a bond salesman at Salomon Brothers. He went through that whole platform and has a firm understanding of how these markets work. What's interesting is that Michael Lewis knows Victor. They worked together at the same period of time. And Liar's Poker actually talks about John Merriweather, who was a managing director there and lead head trader of the mortgage department at the time. Victor went on to become a managing partner at Salomon Brothers and onto Long-Term Capital Management. He's the founder of Elm Wealth, which is a dynamic indexing fund. We're really looking forward to talking to him, but let's just take a look at this little excerpt from Liar's Poker. The third trainee, by far the most interesting, couldn't bear to step off the elevator and onto the trading floor. He rode up and down in the rear of the elevator every afternoon. He meant to get off, I think, but was petrified. Word of his handicap spread. It reached the women in charge of the training program. She went to see for herself. She stood outside the elevator banks on the 41st floor and watched with her own eyes the doors open and shut for an hour on one very spooked trainee. One day he was gone. This might seem absolutely ludicrous to someone, but let me assure you, the level of stress for many people that even want to get a job interview at a firm like Goldman Sachs, JP Morgan, or Salomon Brothers at the time, it's unlikely you're even going to get the interview. And then you're going to go interview against a whole slew of grads from incredible schools with incredible achievements and whatnot. These are very highly sought after jobs. But what's interesting is the way that Michael Lewis explains how he kind of fell into it and the people he met along the way. And these people, they're around today. And it's very fascinating to see that this isn't, it is a fictional book because he has a bit of fun with it. But it's also revealing as to what it's like to work at this prime level of financial marketing, of derivatives, of trading and investment banking. And it's a real treat. And we look forward to speaking to Victor because this will be a wealth of knowledge, not only on indexing and not necessarily even about long-term capital management, but about probabilities, risk-adjusted returns, and how people should view what kind of risk they want to take and bet sizes and that type of idea. He's been on TED Talks, you name it. Let's get in there and talk with Victor. It's a real pleasure to have you here, Victor. Good morning. Happy Monday. How are you doing?
Thanks, Andrew. Great. I'm here in Jackson Hole, Wyoming. It's a sunny day and really pleased to be on your show.
Well, we're excited to talk to you. I mean, it's you've done so much in the world of finance and trading and markets, and you've given it to us in one book that is, as I mentioned before, it's a real excellent piece for someone with a bit of knowledge of the markets, but also does a great job for someone who isn't as familiar with, say, probabilities or risk as well. And I think there's enough for even a layman to jump into and get a good grasp of some of the more basic kind of tenets.
Absolutely. Great. I'm really glad you like the book so much. That's wonderful.
It is great because I now I'm maybe a bit of an oddity, but I've always kind of, whether jokingly or not, looked at almost everything I do during a day as a probability. Like, well, what's the probability of me doing this? And even with friends, I'll be like, well, it's 13%. Or no, I'm not actually using the proper formula or not. And often I probably get caught like on your site where you have the coin toss game, where I have enough of an understanding of probabilities to probably get myself into trouble. That's about the limit.
It's the right place to start. I mean, when we're thinking about right, when we're thinking about uncertainty, we have to have some idea of what, of what might happen. Otherwise, there's no way to make a decision there. We can't do it without some sense of of possible outcomes and what they mean to us.
And at least having that kind of that willingness to understand that there's no decisive, like there's a decision making process within my own brain, and it's weighing out pros and cons, probabilities, or whatnot, in whatever way. But often, I would probably say, especially from reading your book, so I'll speak for myself. A lot of times would be incorrectly, because they hear things on TVs and movies, or instinctively they think, oh, I instinctively should double down, or I should instinctively, and it's like, no. Sometimes our instincts to do something are far, far wrong. There's something biologically internally wrong, or risk-taking for some personalities, might say, compared to what the actual numbers and what the math shows. And that reality of mixing one's internal belief to reality, that can be quite conflicting for a lot of people. And it certainly is to me whenever you see certain things and you think, oh, well, I think I'm different. And that's one of the things I liked about the book, is that it captures parts of that mentality, that even if you show someone, here's the risk, here's the reward, or risk adjusted return, still you can run up to people who think, well, I'm different though. I'm that 0.1%, or I'm the 1%, or I'm this or that. But let's just jump into a little bit of the backstory of how you got to here. And I've told people as well, is that there's lots of different interviews where you talk about long-term capital management. But what I would really like to do is speak a little bit about it, but how you got into finance, where was the interest, and then where it led you, like from the start, to this kind of solution that you have today, or what you've put together today.
Sure. Well, I guess I guess it really kind of starts with me being, young and at the London School of Economics as an undergraduate student there. And, in the UK, as compared to in the US, you just go to university and you study your field from beginning to end. There's no English literature, there's no learn a language stuff. So I was studying, economics, and then you start to specialize, and I specialized in finance and accounting, which is one of the departments there. The head of the department was Mervyn King, who went on to be the governor of the Bank of England later on. And yeah, it was just fascinating. I mean, it was a time when there was just so much innovation going on within academic finance, and really ideas from the late 50s and 60s were just becoming accepted and applied in practical terms to the market. So it was just a very exciting time for me to be learning about this. And with the deregulation that was taking place in the US and Big Bang coming up in the UK, it was just a really exciting time to be working in financial markets. And I guess all of that, was making it exciting to people like myself to get involved. And the more important thing was that all of these firms were looking for talent to bring people in. They were growing. There was consolidation, but there was also growth, and there was this real search for quantitatively trained people. I also was very interested in computer science and was a decent programmer in those days, not so much anymore. And yeah, so all of that, conspired to land me a job with Salomon Brothers in New York in their fixed income research, their quantitative fixed income research area called bond portfolio analysis. And then from there, sort of, I just floated with the current, pretty much.
And it's funny because I did a bit of a quote from Liar's Poker, because I wanted to draw people's attention to The Big Short, which is today a lot of younger people would know. Oh, I know that movie. That's really wild. With Michael Lewis, to bring it back to this first book, Liar's Poker, where he was in that Salomon Brothers class. I think it was 1987. So I don't know if you knew him or knew of him or anything, but you certainly are in a strange way a pivotal character, even in that book, because you worked with John Merriweather, who was the head of the bond.
That's right. Yeah,
department.
And I knew Michael. I knew Michael at Salomon Brothers. And but then afterwards we became more friendly, and I'd say that Michael and I are definitely friends and stay in touch. I mean, he's super busy, so I don't get, much of his attention these days, but yeah, definitely keep in touch with him, and have loved many of his books and things that he's written. Actually, right after LTCM, he wrote a good article about LTCM, the people, what went wrong, etc. That was one of the better pieces written at the time.
And see, and with long-term capital management and the issues that happened there, and I'll just speak for myself. I know for me in my life, the best and most growth lessons I've ever learned have been from hardship. It's not the big wins. Like I barely even remember big wins like that. I know they feel good, and that's what everyone's going for is, a win, a win, a win. But those really hard losses that at first breath would seem like, I don't know, like, where did this come from? Like, how did this happen? Those, if someone meets that obstacle and meets and goes through it and does the soul searching and does the real thought behind it, I find for myself, the growth is extraordinary. And I don't want to speak to you, but it seems like you did a lot of work after that to look what happened here. What can we do to apply that could remedy some of the issues that we would have had?
Yes, I think there's a lot of truth in what they say, that if you don't have any failures, it means that you're not taking any risk, and and you're not learning and progressing. That you're going to have failures. What you hope is that your failures are more minor and manageable as you go along. There are certain failures that just stop you in your tracks. So you don't want those existential choices to be failures. But indeed, there was so much that I learned and took away from those experiences.
But it's amazing to see what you've come up with, and that's kind of what I wanted to spend more time on with this conversation, because, like I said, there's lots of videos on long-term capital management. There's lots of other interviews where you've done, and there's even videos about the TED Talk, Where Are All the Billionaires? If someone wants a quick, I think it's 14-minute kind of lowdown on, I guess, the thesis of the book, or which eventually became the bigger book. I wanted to jump in and talk about the creation of Elm Wealth and how that came about. I look at it as a solution to some of the issues that you had popped up earlier.
Yes. So I'll tell you the story of Elm Wealth. So after the collapse of LTCM in 1998, it took me a few years to extract myself from that. We were working for this consortium of banks that had recapitalized the fund and that they owned, and we needed to liquidate it for them. They wanted to get their money back, which we, liquidated all the positions. They made a small profit for that year, and then I stayed with my partners for another year or so, helping them to start a successor fund. But I told my partners that I wanted to go on sabbatical, and really I just wanted to clear my head. And I was about 40 years old at the time, just under. I had 3 kids, a new one that was about 1 year old, and a 6-year-old. And I just wanted to take a break. I was 40, and I knew that I would stay engaged in business activities, and I kind of felt that I could easily start again when I was 50, with hopefully a little bit more experience and judgment. And it's not like in other professions where when you're 50, you're washed up. When you're 50, you might be better at certain kinds of judgments when it comes to business things. So I took a 10-year sabbatical, and during that time, I thought about what would I do next. And the only thing that I promised myself is I wouldn't go back and do something that was the same, that I wouldn't work at a hedge fund or be a prop trader at a bank or something like that. And I looked at a bunch of different things. And at the same time, I was also, for the first time, really focused on managing my family's savings. And, I was really finding it difficult to come to an approach that I really felt comfortable with and that made sense for a taxable high net worth individual. And eventually, after trying a lot of other things and trying, chasing alpha all the time and investing in private equity and venture and angel deals, I just decided that I just wanted to invest in index funds. I really liked the idea of trying to harvest the long-term risk premium of equities in a diversified way, tax efficient, low cost. And one of the things that just really killed me with my LTCM experience was owning really good investments, but because you were losing money, that you had to sell them. And so I just wanted that to never happen again in my life if I could help it. And the way to try to make that not happen is to not use leverage. That's number one. And to not get too far over your skis. And so I really was thinking a lot about what does it mean to not get too far over your skis? And this kind of led me down this whole path of really thinking about what is risk aversion? Where does it come from? How do different people sort of quantify their degree of risk aversion? And that led to to me adopting an approach to investing that really felt comfortable to me, which was investing in index funds, low cost index funds. They're really low cost today. When I got started doing it in like 2007 or so, the index funds were still really inexpensive, but they were twice as expensive as they are today. They've just continued to even get more and more to improve and become better and better, lower and lower costs, better products, greater liquidity. And but the other thing that I realized is that I just didn't want to sort of do a set it and forget it thing. I'd lived through the late 80s and seen what happened in Japan. I had lived through the dot-com bubble, in 99, 2000, and saw it deflate in 01. And I just felt like, indexing is the building blocks that I want, but I need to keep my eyes open to some degree to think about how much do I want to have in these different equity markets. I don't want to just be so passive that one day I wake up and it's like, oh my goodness, 70% of my family's savings is in Japanese equities, and that, that didn't quite happen back then. But, if it had gone on further, anything is sort of possible. I think that's what these different events teach us, is that anything is possible. And so I wanted to be, I wanted to be eyes open in terms of expected returns and the risk in the market. And so all of it kind of came together into a dynamic index investing approach, which is what Elm Wealth delivers to clients in a very low cost way. And once I started to do that for myself, obviously I was talking to my friends about my journey and asking them what they thought and telling them my thoughts. And then some of them started to say to me, Vic, if you do this as a business, we'd like you to manage some of our liquid assets too. And then that was the birth of Elm Wealth in 2000, at the end of 2011. And and it's been a great journey since then. I've been really happy with it. It's been a pretty low stress. Doing something that's very transparent and very algorithmic really takes the stress and pressure off of me as the person delivering the service. And the clients and all of our clients are happy because they know exactly what's going on. And if they change their mind about the approach, they know what it is. They're not making a judgment about me and my skills or anything like that. They're making a judgment about an approach to investing, whether they like it or if they change their mind and don't. So
in a weird way, it takes out a lot of mystique. Say for me, even growing up, and it would be the same for a lot of people that they're watching, say like a Wall Street, and it's the stock picker, and everyone thinks, oh, he's a genius. Look at him. He's got an edge. He's got this. And that's what a lot of people will assume goes on, and that kind of glamour of analyzing one stock in one sector. But you realize the difficulty in doing that, of finding the right market, like the right country, geography, then the right sector, and then all the companies, the right company. And for them, say you want the big win, say, oh, they're going from a startup to a vertically integrated delivery of that. You go, okay, well, along each step of the way, the level of risk and complexity is amassing. And because they see an Amazon, a Facebook, or something do it, they go, well, it can happen. But they don't. Once again, that comes back to the probabilities of the level of difficulty, even with a great management, is very, very difficult.
And investment management is one of these weird goods or services where the more that you pay for it is not necessarily indicative of getting a better product. In fact, it's very much, I think there's so much research that's sort of telling us it's the other way around, that the more that you pay for it, that it's probably a less good product in terms of your expected risk return that you're expecting to get from it. And so, like, I know that if I go out and I'm going to buy a Bentley, versus buying, a Ford Taurus or something, like, I know that Bentley, at 10 times the price is a better car than the Taurus. There's just no doubt about it. Now, whether it's, 10 times better, who knows? I can't say that, but I know it's better. I'm paying more and it's better. And, like, in cars and in most products out there, in almost everything, like, you can be pretty sure that if you pay more for something, you're getting a higher quality product. It may not be worth it to you. You might want the less expensive, lower quality product. That might be better value to you, but you know that it's higher quality, the higher priced one. But in investment management, it's really not that way, as far as I can see, and from reading, all the research out there, that's like, the more you pay for it is not a signal that you're getting something better. In fact, it seems to be a signal that you're getting something worse in general, and especially when you look at narrow things, like, I mean, there's still, you can still invest in an S&P 500 index fund and pay 50 or 100 basis points for it. I mean, it's incredible. It's incredible that, it just seems like that should be, like, illegal, but it's not. But, you can do that, and you can get the same thing, for 3 basis points. And, but there's, like, some, mystique or whatever, that goes around these higher priced things. And, I think that kind of, that mystique, that mystique and reputation, in the world of investing, where there's so much uncertainty, people seem to be willing to pay a lot to say, oh, I have an account at, and fill in your white glove organization.
But no, and I get it, and people will do that. I mean, they're happy to do that. But it's what's so great about the book too is you walk through, like, with your clients, a different way to look at risk as well, because anyone who's opened an account will have gone through the myriad of questions about your risk profile, which will be more of a psychological, personal intuition about it. Which, yes, it's good. It's a good place to start, but really isn't. And you can tell me if I'm wrong. Really nailing down what your actual risk aversion is and what you're willing to take on compared to what you're willing to lose. And the upside and the downside, we seem to view them very differently as well as human beings on the risk. So maybe you can walk us through that without getting too much in the weeds about our understanding of risk.
So that starting point that you mentioned, Andrew, exactly, that, so much of the risk calibration that goes on at wealth advisors these days, is just this sort of very, is this very generic thing. Like, do you think that you're more or less risk averse than your friends? Do people view you as risk averse? And it doesn't really take us to a particular place. It might help to put you on a spectrum relative to other people, but if we can't tie down anybody's risk aversion quantitatively, we're not getting very far. And so, what we talk about in the book, and this is all, part of, sort of mainstream conventional research on choice theory, and it's been, these ideas have been around for 150 years or even longer than that. But I think real choice theory started in the early 1900s and then had this big breakthrough in the mid 1900s with Johnny von Neumann and Morgenstern, his collaborator, when they wrote the theory of games in around 1945. And basically, like, we can quantify how risk averse we are. But why are we risk averse? Let's just start with that for a second. Why are we risk averse? And then let's talk about quantifying it. The reason that we're risk averse is that, in general, most normal people experience a decreasing marginal utility of more wealth, more spending, more consumption, right? So, like, that the first $100,000 that you're spending on yourself gives you a certain amount of happiness, and then the next 10,000, is increasing that by less than the last 10,000, and the next 10,000, is increasing your welfare and happiness and all that, but by less than the $10,000 that you spent before that. And you can think of it, also, if you want to, like in the book, we talk about gummy bears, the non-dispensary type. And it's like, because we like, James, my co-author, and I, we like to eat gummy bears to treat ourselves sometimes. And it's like, okay, like the first gummy bear is great. Second one is still good, but not quite as great. But, by the time you get to the 20th, you're starting to get pretty, saturated with the enjoyment that you're getting from that 20th one. And so that gives you, when you plot that out, right, it's like, put gummy bears or put money on your x-axis, and then put welfare or happiness or what economists call utility on your y-axis, and you get a graph. When you chart that out, you're going to get something that looks concave, right? That's sort of going up, but going up at a decreasing rate of increase. And so now when we face a gamble where we might make or lose a certain amount of money, if I'm taking a gamble where I'm going to make or lose $50,000, I'm going to be risk averse. I need to be paid to take that gamble, because if I win, the improvement in my happiness or utility is less than how much I lose if I lose that gamble. And so I don't want to take that gamble, because it's like the expected value of it is negative unless I get a payment or an expected gain for doing that. And that is the basis of risk aversion. And the amount of that concavity in that utility curve is a measure of our risk aversion. Okay. So now we say, okay, now what about trying to calibrate it for people? You talk to people, how do you calibrate it? Well, you just ask them a lot of questions about simple gambles. And, we like to talk about it in a kind of coin flipping, more abstract way, so that we're not also at the same time, bringing in their view of the riskiness, what is the real riskiness, say, of the stock market. Like we can also say, well, listen, if the stock market has if you believe, let's imagine you're in a world where the stock market has an expected return that's 4% higher than safe assets, and the riskiness of the stock market is about normal, how much equities do you want to have in your portfolio? And we ask our clients that question when we get them started with us. And but what that's really doing is it's calibrating two things at the same time: their risk aversion and kind of how risky they view the stock market to be in normal times. And so it's a little bit more complicated like that. And we're not getting directly at risk aversion, which we would get at if we just asked a question of, listen, how much compensation do you need to accept a gamble, a 50-50 gamble, where your wealth is going to go up by 15% if the coin comes up heads, or you're going to lose 15% if the coin comes up tails? How much do you need to be paid to take that gamble? And somebody might say, well, I need to get paid 5% to do that. And then we can use that to calibrate their risk aversion. And, in the book, we give a really simple, a couple of simple thought experiments that people can run through and to come up with their degree of risk aversion. And we've surveyed hundreds of people with these more abstract coin flippy questions. And what we find is that people all kind of people all tend to land within a relatively narrow range of risk aversion, from questions that are really being posed in a relevant way. Now, some economists have gone and asked college students, like, here, you're going to flip a coin for $100. You make or lose $100. How much compensation do you require to take this coin flip for $100? And they say, oh, I need $15 of compensation to do that. And then they say, oh, look how risk averse people are, but those are like ridiculous posings of the question, that when we think about really small bets, our heads don't really wrap around it in a way that's consistent with how we think about consequential risk, which is what we care about when we're making our financial decisions in life. I hear about people saying that there's some point where I'm totally satiated, but I think you can be kind of satiated from a personal point of view, but thankfully we all have the ability to give our money away. We can give our money away to family, to friends, and to philanthropy. And for most people, almost everybody, that giving money also provides us with utility. So I don't think that we ever really get saturated. And when we talk to very, very wealthy people about their financial decisions, we don't come across any billionaires who are saying more money is not better than the same money that I have now. That nobody gets totally horizontal out there, because they can always, you can always find gainful things to do with your money, especially when, like, okay, you get very, very wealthy. Well, now at the margin, it's all about giving it away and, feeling that you're making the world a better place, or that you're having influence on the world, or however you want to think about that philanthropic drive. That is certainly a source of utility as well. So, I think that, there's like three things that we can do with our wealth. We can spend it on ourselves, on consumption. We can give it to our family, and we can give it away to others in philanthropy. And those are like the three things we can do. The one thing that is not really, we don't count as a really legitimate use of money, is to count it. Like, counting it doesn't really, make it in terms of a real use of the money. That wealth is going to be is that we're going to get our increased happiness from wealth in a sort of rational framework from one of those three uses of wealth. And we can try to think about what the utility is and how concave and risk averse we are. It gets really complicated when you're running, when your money at the margin is all going to a foundation that's all going to go to different, causes that you think make sense. How risk averse should you be with that is a really good question. And some people have said, well, I shouldn't be risk averse at all. But, as we talk about in the book, whenever you say, I shouldn't be risk averse at all, that means you're going to lose all your money.
Yeah. Yes.
So, that when people say they're risk neutral, there's they don't really, in general, they don't mean it. Every once in a while, somebody comes along and does mean it. But
I was going to jump in here as well and talk about like the simplicity of the index funds is remarkable. It makes it very simple, and maybe kind of tie in where, like, we were talking about, like, the mystique of like the hedge fund or the person managing a portfolio, and maybe it's like the white label fund, and it's, I'm in this fund and whatnot. But as far as market performance, and even take the fees out, we know that the cheapest thing you're going to do is buy an index fund or an ETF. That's the cheapest you could do. And why would you pay more, especially whenever market performance wise? How are you going to do in an index fund compared to some of these other ones?
Yeah, so we think that these big, broad, market cap based index funds are really the right building blocks for people's portfolios in general. It's the right starting point. And there's so much criticism out there of index funds. And where is it all coming from? Well, it's all coming from active managers. Of course, if you're an active manager, if you're a stock picker, if you're doing things that are, where you're trying to get paid to do them, you're going to come up with all of these different criticisms of index funds. And I think that there are two main categories of criticisms of index funds. There's one set of criticisms, which are index funds are ruining the world. Index funds are worse than Marxism. All of these things, right? Like index funds are destroying capitalism. Index funds should be illegal because they're concentrating voting power in BlackRock and Vanguard. So those are, we'll address some of those. But the first thing I want to say is, like, all of those criticisms should not affect an individual investor trying to make a decision about what to do, because those are like these, macro policy issues, which may, I don't think that they hold much water. But I think the first thing is for people that are thinking about investing in index funds, they've got to think, what's the right thing for me to do? I don't need to worry about, the impact of what I do is just going to be so small. I don't need to worry about whether index funds are ruining capitalism, really. Let me do what's right for me. And then there's the second category of criticisms that might be, index funds are not good. You can do better doing these other things. So let's deal with the second category, which is the more important and relevant category for investors. Are there better things to do? Well, there are better things to do than invest in index funds if you can pick stocks to beat the market. It's just that simple. But when you want to pick stocks to beat the market, you have to remember two really important things. The first one is that there's somebody that's on the other side of you. When you're picking stocks, there has to be somebody else who has the opposite view to you relative to the market cap index, who has the opposite view, who thinks that he or she is right and that you are wrong. So you think you're right, but there's somebody else out there that also thinks they're right, and they have the opposite position that you have relative to the index. They have the opposite deviations relative to the index. And so now you have to say, well, what about that person? Am I smarter than that person? Do I have some
Yes.
information? Where do I sit in the food chain? And there are some people in that food chain who really have a reason to believe that they're the apex predator, right?
Yeah.
They've
Yeah.
got 200 people working there with physics PhDs
Yeah.
and linguistic PhDs, and they're spending $500 million a year on figuring out, how to beat the market, and they've been beating the market for the last 15 years. Those are the apex predators. They're on the other side of you,
Yes.
unless you are working there, right? They're on the other side, and you've got to think to yourself, Jesus, who do I think that I'm outsmarting here?
Yes.
So that's the first thing, and then the second thing is, right, that even if you kind of think that you can do better, you have to realize that you have to do better by quite a lot to overcome the extra risk that you're taking by
Yes.
having a concentrated portfolio. We call that the risk matters hypothesis, and we've written about that in some research papers. And then there's the cost matters hypothesis too, which you also need to get a higher return to pay for any extra costs there are. If you're paying somebody to do your stock picking, there's going to be some extra costs. If you're doing your stock picking yourself, you might have some extra costs in terms of transactions cost or taxes or whatever, if you're active. But even if you feel like you don't have any extra costs, you still need to compensate for taking more risk in a concentrated portfolio relative to the market portfolio. So I think that the arguments on the side of doing something other than index funds is better than index funds really is challenging for most individual investors. Then we turn to the questions around, is indexing ruining capitalism? And, I just think that they're overall, not very strong arguments, and that there's so much capital out there that wants to beat the market and be involved in setting prices that we're so far away from a place where the market will not have people setting the right prices on everything. Even if the market were 100% indexed, you would still have hedge funds running long and short positions trying to beat the market, and other hedge funds trying to beat the market too, and they would be trading and setting prices. So I don't think that indexing is ruining capitalism. And I think that the issues around voting and concentration of holdings, where Vanguard and BlackRock and State Street, have the voting rights on, a really significant slice of corporate voting. I think that's a legitimate concern. I don't think it's a problem right now. I think it's something that needs to get fixed, and people need to be made more comfortable. And there's all kinds of reasonable solutions to that, from getting all investors to sort of somehow cast their votes, and then having BlackRock and Vanguard and so on reflect that, to outsourcing. I mean, I think there's all kinds of ways. And I think that unfortunately, Larry Fink and BlackRock have kind of made this into more of an issue than it would be if he were more like the CEOs of State Street and Vanguard, where they're like, hey, we're not telling all the companies in the world the way to manage their businesses, and he's sort of backed off that. So, but anyway, I think that there needs to be some solutions to that over time that just make everybody more comfortable. As you know, it does feel like indexing is just going to keep on becoming a bigger percentage of ownership of all these companies, and it's kind of wonderful that we have at least three mega index fund sponsors out there. And we're so fortunate that one of them is Vanguard. So we're not in some sort of, duopoly, kind of avaricious duopoly situation. So, yeah, I mean, I think there could have been more problems with indexing if there was just one index provider that was very profit motivated. I'd be a little bit more worried, but thank goodness for the existence of Vanguard. So that's, trying to talk about all of these criticisms of indexing would take a long time, but some of it is just so bizarre, Andrew. I mean, like there's this guy, Michael Green, who's always, sort of riffing on how bad index funds are. And I was reading something he said the other day where he was saying that, stock buybacks, that index funds make the distortionary effect of stock buybacks worse. I was like, oh, really? I don't know. That doesn't sound quite right. And when you think about it, I think he's got it actually backwards, right? Because an index fund, when a company is buying back their stock, it's going to have, it's not quite the same as a dividend, because you've got to entice people to sell their shares to you as the company buying back the stock. And it's going to have some price impact. There's going to be some inelasticity. I mean, in theory, right, when the company says, instead of doing a dividend, we're going to use $1 billion to buy our shares back. And then everybody should just say, okay, here's some of my shares. And that's how it should work in theory. But in practice, I don't think it works like that. I think there's impact from buybacks. But the index funds make it better, because when the company says, I want to buy back, 2% of my stock, the index fund is like, boom, here's 2% of our stock, because we need to own 2% less shares of this stock after the buyback. There's going to be an index rebalance and we need to have 2% less. So they just give the stock to the company without any inelasticity whatsoever. And then the company that's paying the dividend, like AT&T, is paying all this dividend money out, right? The dividend, well, first of all, the dividend has to be paid out to all of the investors, right? But the buyback, when the buyback happens, and so if the company is paying, if the index fund pays out all the dividend from AT&T, but then index investors put it back into index funds, fine. But now it goes into AT&T and a little bit of the stock that's being bought back. But the bigger effect that's going on is the stock that's being bought back, that money. So now the index fund sold some of the company that's buying back its stock. So now it has this cash, right? And it takes all of that cash and has to buy AT&T with it. So the effect is the other way around. It's these buybacks, if anything, from the point of view of the index fund, is sort of helping the companies that are paying the dividends. And here's this guy saying it's the other way around. I mean, it's just kind of bizarre. Like, everybody is out there with all of these, crazy ideas. I mean, while we're on it, if we can just take one more second, that there's other people who say, investing in index funds means that you're investing more in overvalued companies and less in undervalued companies. Right? Like that argument is running all over the place. Well, if the argument is logically flawed, because if which are the companies that are overvalued and which are the companies that are undervalued, then just go off, sure, don't invest in index funds, just do the companies, go short the ones that are overvalued and long the ones that are undervalued. But the whole premise of investing in index funds is that I don't know which companies are overvalued or undervalued. So if I don't know which companies are overvalued and which are undervalued, then the argument that investing in index funds is putting me into the overvalued companies is just fundamentally flawed. And this has been, this was debunked, like 20 years ago by Andre Perel, the Harvard Business School professor, debunked it, more than 20 years ago. And still people are just saying it. but it makes no sense if you don't know which are the overvalued or undervalued
Yeah.
companies. Then it's not true that that indexing is
It's interesting
hurting
because
you in that way.
if you put it back to the person and said, okay, you feel that strongly and you know which the ones are that are overvalued, I'm looking forward to seeing your short position in XYZ. And of course,
I mean,
whoa, hold on, I don't know if I want to do that.
If you're that person, don't invest in the index fund. But the whole premise of the thing is we don't know which ones they are. So you can't have it. You can't have your cake and eat it too. You can't say, I'm not a stock picker, but I'm not a stock picker, but I can do better than the index fund.
Yes.
Yeah. It's just inconsistent to say, I cannot pick stocks, but I can pick something that's better than this index fund. That you can't say those two things logically consistently.
No, and it's fascinating because you hear a lot of these criticisms, the voting one certainly, but to me, like you pointed out, that seems like a very, very easy remedy overall with, because that could be fixed. I mean, a policy, they'd probably be open to it to some degree. That doesn't seem like a big stumbling block on the overall. Can you make money in this? Is it efficient? And this is kind of where I'm getting is, you're going to do long-term risk-wise better in an index anyway, cost-wise, tax-wise as well. But it comes back to the idea of like an efficient market, because you're finding in any way, it's going to become efficient. It might go out of sync a little bit as, funds are gathering or index funds were first taking off. But it seems to me that the markets are just going to become efficient and work regardless of the size or one, the being in an index rather than individual.
Yeah. And when you're thinking about yourself, you got to do what's right for you and not worry about, all these other things, really. I think that's really important.
And what I think is interesting too is, and this is kind of a funny way when you were mentioning before to look at it is, if you do this correctly and say you grow up and you start doing well, you make a significant amount of money and you ride that curve, your first intention is, I want to make a lot of money. Whereas it sounds contradictory that, so at this point, I'm giving a lot of money away.
Yeah.
Whereas if you go so you go, wait, what? That doesn't make, like, in our brains, that seems so silly, but really their end goal is, I want to be able to give it away. But in between there is the challenge.
Yeah.
But let me just a couple other things about human capital I wanted to touch on, because that rolls into, I wanted something for younger people to hear and to listen to capture their thought process. And I think it ties in a lot of aspects here fairly well. Someone makes a lot of money in crypto. They're young, there's a lot of luck. There's a lot, whatever someone believes. What's the best way for someone who's young to look at really impacting their life long-term in reality? And because we all hear it's, become an influencer, these are such long shots. Once again, probability wise, very unlikely. What's the best thing someone could do to build up their long-term potential net worth or earnings capabilities?
Sure. So, when it comes to human capital, I think that the same ideas about return and risk come into it. So, that you need to really think about not just the expected return or the expected your expected compensation, but you need to make some adjustment, which can be really significant for the riskiness of it. So you can't. I think that if you look at your career and say, well, if I go down this path, there's a 10% chance that I make $100 million. And a 90% chance that it doesn't work out and I have to start over again. And that has an expected value of $10 million, right? 10% times 100 million. That you can't look at that and compare that to saying, here's this other path that I can go down where, I have a pretty low risk way of saving up $3 million, over time, like some other career choice that is a much lower risk, but $3 million compared to a much higher risk expected value of $10 million. Like, for the framework that we talk about in the book, which is adjusting these things for risk, that you need to adjust them for risk. When you look at that, for most people, the $3 million one is going to look a lot better than the $10 million expected value. It depends on your risk aversion and everything else. But in general, I would say that a 10% chance of hitting it big and a 90% chance of making nothing and having nothing after 10 years is, has a really low, what we call certainty equivalent value. The other one has a certainty equivalent value of close to 3 million by definition. We stated it like that. We said, here's this career. You've got a very, very high chance of making $3 million of savings over time. So there needs to be a risk adjustment applied to these decisions. I think that's what our book and our thinking can contribute to the decision. But then, there's all these other things that are super important to also bring into it. What you're good at, what the market is saying about different things. And, I think that there's just a lot of really good advice out there about thinking about your different career choices, really sound, rational advice that I've seen in different books. I think that the personal finance literature does a pretty good job in helping people to try to think in a very pragmatic, rational way about career decisions, right? Like, okay, I can become a phlebotomist, which is, I learned this word relatively recently, somebody that is trained to take blood, right? A phlebotomist.
I didn't know that.
I could become a phlebotomist, and what does that pay? And what does the long-term thing look like, et cetera? And, I think I could do that. Like, you got to think about all these, you got to think about what the market is looking for. Like right now, we know in the US at least, like HVAC, right? That's air conditioning and heating.
Yes.
Like if you're an HVAC technician, you are going to be in demand for a while.
Yeah.
And so, it depends on what you think your talents are, your interests, all of these different things. But you got to look at what the market is saying. And then you've got to do a pretty hard-nosed rational analysis. And, there are so many, I think in this whole trade and technical training area, there's all kinds of things that you can try to do as a profession where the training cost, is 10,000 US dollars, 20,000, 15,000, 8,000. I mean, it depends. If you want to be a commercial pilot, it's more expensive than that. But I think if you want to become an HVAC specialist, you could probably do it for 15,000. If you want to become a welder, I mean, there's so much welding demand out there.
Yes.
So I just heard a review of a book that's coming out by Scott Galloway. Do you know Scott Galloway? He's this NYU professor, has a really big following as an influencer, really, interesting guy. And he just wrote a book called The Algebra of Wealth. And a lot of it talks about career choice and thinking about your career choice. And I've read other things. I can't remember the books that I've liked the most that talk about these things, but I would say that just try to be really pragmatic and rational and hard-nosed about it. And I would say kind of stay away, I hate to say it, but either stay away from those real big long shot lottery ticket type careers, or set a stop loss for yourself. It's like, I'm going to become a professional golfer. Then just make sure that you say, okay, well, by the time I'm 24, if I didn't get my tour card, I'm stopping. Don't be like, oh, I'm 24. I really feel like I'm just a little bit, if I could just shave a couple strokes off of each round, I can get my tour card. No, set a hard stop somewhere out there. Becoming a professional golfer is a lottery type of payoff. Of course there's skill involved, but it's still, the probabilities are like a lottery ticket. And so, if you want to pursue those things, pursue those things for a little while and then stop. And if it hasn't paid off, then stop. So I don't want to say don't follow your dreams, but don't follow your dreams for long, and have a stop loss and a backup plan.
I think that's great. And I always like the sports analogies because it's, especially for young men, it's easy to understand. Say in Canada, it's hockey. They go, okay, I'm going to know pretty early on. By 16, I'm not going pro. 16 or 17. To keep on really going at 24, the probability is almost zero. Like it's not going to happen. So there's a short lifespan, and if you've got the skill and you've got everything, they know what that target is. And I have to remind people that, yes, you need to invest in yourself and education, and that's your human capital. But you need to be reminded of, and you were mentioning this before, who you're up against. So if you're saying, I want to be in the market and I think I want to be that guy, uh, I mean, I'm talking to one that say from Bonfire of the Vanities would say a master of the universe. Here's someone I'm speaking to right now. If you want to follow your path to attempt to get into London School of Economics, to then get into a company like Salomon Brothers, like the probabilities of that are very low for even very smart people. It's not easy to do. And I'm not trying to blow smoke up your butt or pride, but it's literally kind of looking at, like, I want to be LeBron in the NBA. I want to play at the top level. I want to be at the Olympics. And you say, well, are you that person? And a hard look for most people go, I'm probably not. Like, I'm high, I'm good. You go, okay, that's fine. But so as long as you know what the risks are, and athletes tend to know, if you think you're Tiger Woods, you probably have a good indication that you're Tiger Woods. If not, reality will show you that you're not. You're going to lose a lot. People don't see it as much when they look at the career path. And occasionally there'll be movies like The Big Short, or they'll see something, they'll go, wait a second, this guy works 100 hours a week? And that reality of what that looks like. Wait, for how long? Like years. Then they think, oh, am I that person? Can I handle that? Like that kind of workload? Maybe touch on that a little bit for someone to realize, if they're going for certain glamorous or high-paying influential jobs, what that entails or what that looks like.
No, I mean, I think you said it really well. I mean, it's also, you've got to think about what everybody else is doing. You can't make these decisions, just looking at yourself. The other thing at the beginning of bringing up this human capital thing, we're talking about, people making money in sort of speculative things, maybe short-term options, meme stocks, coins, whatever. And, I think that the other thing to bring into the discussion of human capital is, when you're young, hopefully your human capital is significant. I mean, I think that, people when they're young, their human capital can be measured in the millions of dollars, depending on if their savings program and all of that their savings discipline and their mindset, etc. And now, they've got, $100,000 or $50,000, and they're spending like a lot of their bandwidth on, how am I going to grow my $50,000 into $10 million? Well, I just think you're so much better off focusing all of your bandwidth and all of your mental acuity on your career, and taking that $50,000 and putting that into an index fund, and letting it grow in a tax deferred account or whatever. That the chances that you're going to turn $50,000 into $5 million through trading is actually pretty similar to, like, your chances of becoming a pro hockey player or something, assuming that you know how to skate. So, I think that's the other part of it, is you've got to keep your focus on the stuff that matters, and don't get distracted. Have hobbies, but let those hobbies be things that are good for your mental health. Speculating is not good for your mental health.
No, it's not.
There's all kinds of hobbies out there that take your time and are positive for your human capital, because they're positive for your mental health. And I think that's really important to keep focused on those things.
And what's interesting is, as you're an academic as well as a practical applier of this, so for you, it's a bit of both. So you naturally are inclined to be very curious. You're very interested in this. This is the market you like, and understanding this. So it's not the same as someone who just says, I want to speculate because I want money. Like, that motivation is not enough to really get you too far or anything. Where it's you have an intellectual curiosity to, I need to understand it, if this is right. Is this application? Which is a very different mindset than someone.
Yeah. I mean, I think that's right. I think you can, that you can be an observer of the markets, consumer of news, watching what's happening in the world, but as an observer, as an interested, curious person trying to understand what's happening in the world, without feeling that you need to speculate. I think the speculation turns it from this thing that's very nourishing for your mind into something, where now there's stress and, there's all this, I mean, it's just a disaster.
And I love that analogy too, because I know plenty of people that HVAC, or especially welding, And if they applied their energy and cut off the noise and just put their money aside, let it work for you, put it in the index fund, let someone else manage that. If they put that energy into going, if I started my own HVAC little thing, or started my own little welding company and built it to 2 to 5 to 10 guys, built it out, yeah, you're on your path. Certainly in Canada, they're very, very high paying jobs. You are maybe not 10 million, but you're going to build a company that's bringing significant revenue. It's going to be fairly decent.
Yeah, I was out walking my dog the other day, and somebody was telling me about the profitability of being in the auto glass business, right? Like there are just so many things out there. You focus on them, you look around, you talk to people, what's good, etc. I mean, it's just there's just phenomenal opportunities out there to accumulate wealth and to be providing a service of real value to people.
Now, I'm not going to continue with this, but maybe on a further conversation, we touched a little bit on technology. I know you've got a love for it. And when you did start at Salomon Brothers, it really was a pinnacle point where you start to see like rocket scientists, like the application of different types of things to, I'm studying thermodynamics and air temperature rates, and somehow that's going to apply to the markets in some way. Fascinating work, this whole coming together of different skill sets and changing what we have today, maybe down the road talking about like how algorithmic trading and the technology today, is that pro, is it negative indexing, or is that make the case more for indexing? Maybe that's something down the road we can get into. I think it's too big to talk about now, but I'd love to get your thoughts on technology as it came about then to where it is today, and how that fits into Elm and your overall thesis as well.
Okay, sure, we'll do that.
Perfect. But I really appreciate you spending the amount of time you did with us today. It's fascinating. I mean, I can talk about the probability functions all the time, because I just think the way our brains are meant to be, that we are these either very flawed probabilistic machines, but we can also be trained to be better at it. And I think that's the big hope in it, is that if we spend a bit of time and effort, we can be trained at being better at that. And that's very hopeful.
Yes, absolutely. I think there's so much hope, and in general, I think that that individual investors are just getting such a better shake than they did 20 years ago, and it's up to us to take advantage of what's good out there and to avoid what's bad. I mean, there has been some distraction that's come along with the good stuff, but I think overall that for most people, I think we're going in a good. I'm really pleased with overall what I see out there in terms of the direction that we're going, even though there's still some things that are a little disappointing or concerning to me on the speculative side. But overall, I think the flow is in a really good direction.
Excellent. Right. And sometimes maybe as human beings, we need some of these wild speculative things, like what you call like extraordinary madness of crowds. Maybe we need this every once in a while to shake our brains out a little bit.
Yeah. I think there is some learning there, and look, gambling is fun. I mean, we wouldn't have Las Vegas if not. So I understand that people might want to do that with a little bit of their money, and I would rather see people take the same amount of money and put it in markets speculatively than taking that amount of money and putting it at Vegas. At least in the markets, I think the odds are better. For the same amount of money, the odds are kind of better, in the financial markets than they are in Vegas or at the gas station buying lottery tickets for the same amount of money. I mean, the problem is that I think usually people put a lot more money into speculating in the market than they do. They go to Vegas, and they're like, hey, I've got $1,000, $2,000, and if I lose it, I got my room comped anyway. Whereas in the market, it's like, I'm going to take my $50,000 and maybe I'll leverage it or whatever. And, but for the same amount of money anyway, I think it's good. We just need to train people to sort of view it as the same as going to Vegas. And then I think it's all fine.
Certainly, I know in the speculative market that I like to look at, what we say, the worst thing that could happen is you get lucky early.
Yeah.
You might fault that to being, having an edge, and it's not necessarily the case.
Yeah.
But that would be another fun conversation as well. And I really appreciate you taking the time, Victor. This is great. Make sure everyone, you check out the book as well as check out Elm Wealth. And I look forward to chatting with you again, Victor. Thanks so much.
Same here, Andrew. I look forward to it and hope to meet in person at some point if you ever make it down here, or if I make it up to Calgary area again, or well, I'm sorry, you're not in Calgary anymore. You're in Vancouver now.
Beautiful
You're in
Vancouver. You
Vancouver
can
now.
go heli skiing up here.
Yeah, okay. Yeah, okay. Vancouver it is. I checked out Calgary, very interesting, but I know Vancouver's a lot nicer.
You'll love it. It's beautiful and there's great skiing. It's just right up the mountains over here.
Okay, awesome. Thanks,
All right,
Andrew.
I'll have a great day.
You too.